There are millions of articles and videos and podcasts out there covering topics relating to saving and investing, yet very few talk about spending, which I kind of find baffling considering if you think about it, we spend most of our life, spending way more than we do actually saving and investing. So that's what I want to talk about today, specifically how to safely spend more money in retirement. So let's get into it. Welcome back to another video from One Up Financial. I am your host, as always, Eric Persogna, CPA, Certified Financial Planner, here to help you increase your income, reduce your taxes, and invest smarter. So what we're talking about today is the topic that I feel doesn't get nearly enough attention as it deserves. And if you think about it, the financial media knows really well what sells and what doesn't. Think about articles like, save X amount of dollars per month, invest in this, and then 30 years later, you will be a millionaire. Or this 12-year-old started a side hustle selling widgets from his treehouse, and now he's making 6 figures a week. You get the idea. Articles and videos and podcasts like this are interested solely in the journey towards creating wealth, and they don't necessarily focus on what to do when you actually arrive at that destination. And look, I get it. No one wants to read about millionaires and how they spend their millions and millions of dollars, right? Well, maybe some do, but most people want to know how to accumulate that wealth, how to get wealthy. Learning how to spend your money is actually a very valuable skill that if you do it right, can lead to a very rich and fulfilling retirement. But the problem is that most people spend their entire life focused on saving for tomorrow, that when the future actually arrives, they don't know what to do with their money. And even worse, they're afraid to spend their money in fear of running out in retirement. That's something very common that I see when I work with retirees. Whether you've enjoyed a lucrative professional career or ran a successful business that now has left you with a substantial amount of money in the bank, you want to make sure you're making the most of those dollars with the time you have left. So what I want to discuss today are 5 ways to help you safely spend more money in retirement. So right off the bat, for starters, before we get into any of the analyticals and the numbers and the percentages, it's so important that you are comfortable with spending your savings, that you make a shift to a spending mindset. Now, this is much easier said than done, as we are, at least most of us, are conditioned to be savers for most of our career. We're generating income, we're saving that income a little bit each paycheck, and then hopefully by the time that we're ready to retire, we have enough to leave our job and coast off into the sunset, right? So we're kind of used to that accumulation and savings mindset, but not necessarily spending. Most investors have trouble parting with those hard-earned dollars, especially when the paychecks stop coming in. So to help make the transition to a spend mindset a little easier, it helps if you look at your financial life in stages. So to keep it simple, stage 1 is the earning and accumulating wealth stage. You're earning money, whether it's at a job or you own a small business. You're saving a small portion of that money, or hopefully a large portion if you can, so that at some point in the future, you can retire. Phase 2 is the distribution phase of wealth. It's when you are supposed to spend your money. It's really a normal part of the distribution phase, much like accumulating and saving is normal in stage 1. The first step is really to get in the right mindset of being comfortable and giving yourself permission to spend your savings, because that's really what they're there for, right? It's for you to enjoy that. Next, now that you have kind of the right mindset in place, what you want to do is start to estimate what a comfortable spend might look like for you in retirement. Now, the retirement strategies that I use for clients vary. I don't necessarily focus on one or simply just multiply their portfolio by a certain percentage. And we'll get into some of those strategies later. However, I always start by applying the 4% rule, which simply states that a retiree can safely take 4% of his or her savings each year, adjusted for inflation, and more than likely won't run out of money in retirement. For me, I think the 4% rule is a good entry point in determining if the spend being considered is reasonable given the amount of savings. So to apply the 4% rule, it's pretty straightforward. You take your total investments, your total portfolio, and multiply it by 4%. Then what you do is you add in your Social Security income to see kind of where you stand. So for example, if we have a couple that has $2 million in investments and their estimated annual Social Security income is right around $40,000. Well, that would mean that they could comfortably spend approximately $120,000 a year, $40,000 in Social Security and $80,000 from their portfolio. A common question that I'll get when going over this is, well, is that reasonable? Is that going to be enough? Like, how do you know? What I like to do is look at how the individuals have spent or what their lifestyle was like before they retire. So let's take the same example, right? Look at this couple and let's assume that they made $200,000 a year. And they paid about 20% in taxes and another 20% went towards savings and or retirement. So the remainder of that 60% more than likely was spent, right? So if we take 60% of that $200,000 income, we get $120,000. So by applying the 4% rule really quickly for this individual or this hypothetical couple, we know that we're kind of in the ballpark, right? They're spending or used to spending 120 grand, and now 4% rule plus Social Security yields almost the same amount, or in this case, the exact same amount, then we know that we're pretty darn close, right? We're in the ballpark. Now, on the other hand, let's say that same example, but what if the portfolio was $1 million instead of $2 million? Doesn't necessarily mean that the plan will fail or that this person, these hypothetical couple would run out of money. It just means that we need to do some further analysis, maybe adjust the portfolio or adjust the spend, at least temporarily, in order to ensure that this, again, hypothetical couple has enough money to comfortably spend without running out in retirement. But regardless of how the math comes out, quickly applying the 4% rule to your retirement will get you started, at least help get you started in determining what you can safely spend in retirement. Next, so once you kind of have a rough idea of what your spend is going to look like in retirement, the next thing you want to do is take that 4% rule, that simple calculation, take it a few steps further. And what you want to do is run what's called a Monte Carlo analysis. Now, this is a little more complicated than the 4% rule, and it involves a mathematical calculation that is designed to give you 1,000 different investment return scenarios based on your spend, based on your investment strategy, and all of your financial life, all of the data, in order to assess the likelihood of your money lasting in retirement. It's kind of like the 4% rule on steroids. Now, this is typically something that financial advisors manage for clients, but if you don't have an advisor, or if your advisor isn't doing this kind of analysis for you, there are plenty of free tools available online through T. Rowe Price and Vanguard and Charles Schwab. They're gonna be pretty straightforward and simplistic Monte Carlo analysis or calculators, but they'll at least kind of get you in the right direction. They'll give you some kind of feedback based on your input. Now, when we run Monte Carlo analyses for our clients, we go beyond simply increasing their annual spend by the rate of inflation, or what's called inflation-adjusted spending. There's nothing necessarily wrong with the inflation-adjusted spending approach, whereby you just take your annual spend and increase it each year by inflation. However, there's just so many other strategies that I think you want to consider before just going with one and not looking at anything else. So in addition to the inflation-adjusted spending approach, here are 3 other spending strategies that you might want to consider. So the first one is called the spending smile. And this approach is very similar to the inflation-adjusted approach in that the annual amount is increased a little bit each year for the rate of inflation, except that it accounts for 2 things. One, that generally speaking, over time, retirees' living expenses tend to decline as they age. In addition to that, healthcare costs generally tend to go up a little bit as you age in retirement. So the spending smile accounts for inflation as well as the declining retirement costs as well as the increasing healthcare costs. And the formula is pretty straightforward. It basically just uses the inflation-adjusted approach and it subtracts 1% each year from that inflation-adjusted figure. That 1% is pretty much derived from majority of people's retirement living expenses hopefully don't involve healthcare. Healthcare is generally a smaller portion of your overall spend. So if you have that smaller portion increasing while a larger portion is decreasing, it kind of ends up right around 1%, or at least that's a pretty conservative percentage that we use when applying the spending smile approach. Next is what's called the floor ceiling approach. The way it works is simply it's designed to give you a pay bump up or down based on how well your portfolio performs using some predetermined ceiling and floor percentages. So the best way to illustrate this is through an example. And in this example, we'll use a ceiling of 20% and a floor of 15%. So let's say that your portfolio, first year in retirement, your portfolio is up 12%, okay? If your portfolio is up 12% in the first year, then that means that your annual spend from that portfolio will be adjusted up or increased 12%, okay? You're gonna get a 12% raise. Now, if your portfolio is up 22%, well, you can see we're hitting that ceiling, right? We've gone through that ceiling of 20%. So we're still going to get a raise. We're still going to get a 20% raise. We're just not going to go all the way through that ceiling. We're going to cap it at 20%. And the same thing goes when we have years when the portfolio declines. So if your IRA and your 401k and your investment accounts are down, let's say 3%, well, we adjust the annual spend down by 3%, but never more than 15%. So it's kind of a nice way where you can get some raises in years when the market's really good and maybe take a little bit off when we have down years in the market. And thankfully, if you look over historical periods, the markets are generally up more often than they're down. So applying the floor ceiling approach will likely mean that you're going to get a lot more raises than you are going to get pay cuts. Another strategy that we use is what's called the ratcheting rule. Now, while I like the floor ceiling approach, the biggest drawback for me is those pay cuts, right? No one likes to see their pay reduced. Everyone wants to get a raise. That's kind of where this ratcheting rule comes in. And it's a little more conservative than the floor ceiling. And what it says is that your annual spend is going to stay the same and it won't increase until the portfolio value increases by at least 50% from the initial starting value. Now, again, there's downsides to everything. And here, yeah, you're not going to get a pay increase every year that the market goes up. But what you're doing is kind of delaying gratification in a sense. And then at the point when your portfolio is up 50%, then you get a 10% raise or a 10% increase in your annual spend. But the biggest benefit to the ratcheting rule is that you don't have to adjust your pay down if your portfolio drops. Because think about it, you're delaying taking any increased distributions from the portfolio when it's going up. So you're kind of waiting for that 50% to accumulate. And then at that point, you're only taking a 10% increase, leaving yourself flexibility to continue to maintain that pace even if your portfolio drops. So again, it's a little more conservative than the floor ceiling approach, but it's kind of like a play off of that a little bit, except that you don't get those increases every year the market goes up, but you also don't have to worry about the pay cuts. Now, there are other spending strategies that I didn't cover today, and if you want to talk specifically about them, or if you have one in mind that you want to just run by me, please feel free to shoot me an email or give me a call. I will respond to you personally. Now, regardless of the spending plan that you choose, you're going to need to fund it with cash while also being mindful of taxes. But if you have a variety of savings accounts and retirement accounts, some of which are taxable, tax deferred, and maybe even tax-free, it may not be easy to determine which accounts to pull from and in what order. Now, generally speaking, I put quotes around generally. Those that are nearing retirement in their, let's say, late 50s or early 60s will likely see their tax rate go up later in retirement when they start to collect Social Security and when they have to take required minimum distributions from their tax deferred accounts. So The traditional order of distributions to fund your retirement account while minimizing taxes goes as follows. The first bucket or the first type of account that you want to use in retirement for funding your spending plan is a taxable account, like a brokerage account. The only tax liability you'll probably incur here might be some short and hopefully long-term capital gains. And you're kind of leaving those tax-deferred and those tax-free assets in place and growing for the future. Number two, the second bucket that you typically would pull from is your tax-deferred accounts like your IRAs. And third, obviously, would be the tax-free or the Roth IRAs. And the idea there is that later, when you have required minimum distributions, you have Social Security income, and maybe you even have other sources of income, and you still need to fund your retirement, well, you can do so in a very tax efficient way. You can pull from a bucket that won't push you up into a higher tax bracket. While this hierarchy of tax efficient retirement withdrawals may work for some, reality is that everyone's situation is different. For example, if you have someone receiving, let's say, deferred compensation early on in retirement, in addition to, let's say, some annuity income, and I've seen this before, well, their tax rate might actually be a little bit higher in early in retirement than it will be later on. So you can see how you kind of have to maybe manipulate that distribution order a little bit in order to minimize the amount of taxes that you're incurring. The point is that you'll want to fund your retirement spend, whatever strategy that you use, as tax efficiently as possible. Lastly, review and monitor. One of the few constants in life is change. There is no one strategy that works for everyone in every situation. The spending plan that may have worked for you in your early 60s may not be the most appropriate for you in your 70s. So it's so important that you remember to consistently review and monitor your spending plan early and often throughout retirement. And when in doubt, always seek professional help. Thanks as always for watching our videos. If you're interested in staying up to date with our market and financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.